The most dangerous moment in your trading career may come after a good month, when your job begins to look like the obstacle. A few clean trades, some growing confidence, perhaps a stretch where your account behaves exactly as you hoped, and suddenly the salary that once gave you security starts to feel like a cage. You begin calculating what you could make if you had 8 more hours each day. You imagine that removing the job will remove the friction. That is where the arithmetic becomes misleading. Trading does not become easier because you have more time to watch the market. In some cases, more time simply gives you more opportunities to interfere with decisions that were already good enough. A trader with a job may be forced to wait for a proper setup. A trader with nothing else to do may begin manufacturing reasons to act. And when trading must also pay the rent, the character of every position changes. A loss is no longer only a loss. It becomes groceries, a bill, a payment due next week. That pressure can quietly alter your behavior before you notice it. You hold a weak trade because closing it makes the loss real. You take a marginal setup because the day has been too quiet. You increase size because your monthly expenses have not changed, even though market conditions have. The market has no knowledge of your financial obligations. It does not produce a good opportunity because you need one on Thursday. It does not care that you left a stable paycheck behind. There will be periods when conditions suit your method and periods when they do not. If your lifestyle requires the market to provide a certain amount on schedule, you may begin demanding consistency from something that is fundamentally irregular. That is not a small psychological problem. It changes how you read price. Watch what happens when a trader begins trading from necessity. Patience shortens. Average setups start looking exceptional. Small adverse movement feels more threatening. A day without a trade feels unproductive, even though doing nothing may be the correct decision. Eventually, the trader is no longer responding to the market in front of him. He is responding to the pressure behind him. So before asking whether you should quit your job for trading, observe a more useful set of facts. Can you remain inactive when your setup is absent? Do you know which market conditions damage your approach? Are your position sizes determined by risk, or by how much money you hope to make that week? When you lose, do you reduce exposure and study what changed, or do you immediately search for another trade to repair the damage? Those behaviors tell you more than enthusiasm ever will, because the real question is not whether trading can replace a job. Under the right circumstances, for some people, it can. The harder question is what happens to your decision making when trading is no longer allowed to be patient. And before anyone makes the leap, there are several conditions that need to be examined, especially the ones traders tend to ignore when things are going well. The market becomes more dangerous the moment you need it to produce money on your schedule. A setup that looked weak yesterday can suddenly look acceptable when rent is due next week. A quiet session begins to feel like a wasted day. You start seeing opportunity where, under different circumstances, you would have seen nothing worth risking money on. That change is subtle because the chart has not changed. You have. When trading income becomes necessary for immediate expenses, the mind begins judging trades by financial need instead of market quality. The question shifts from, is this worth taking? To, can I afford not to take this? Once that happens, patience is no longer neutral. Waiting starts to feel costly. And that is how necessity creates bad participation. The market does not know what you need this month. It can remain dull longer than your patience can remain disciplined. If you demand income from conditions that do not justify risk, you eventually start paying for the privilege of being active. Watch your own reasoning carefully. Before entering, ask what actually changed the setup, or your need for the setup to exist. If the urgency is coming from outside the market, that is information about you, not information about price. And once you remove the paycheck that used to absorb that pressure, another problem appears. What happens when you suddenly have all day to trade? When you trade around a job, the market often has to earn your attention. When you trade all day, your attention starts looking for something to justify itself. That difference matters. Hours in front of a screen create the illusion that more observation must produce better judgment. But price is not equally meaningful every minute. The longer you watch, the easier it becomes to assign importance to ordinary movement. A small push begins to look like momentum. A minor pullback starts to feel like a signal. You are not necessarily seeing more clearly. You may simply be seeing more. This is how unnecessary decisions enter a trader's day. The market can offer one clean opportunity in 6 hours and nothing useful in the other 5. Full-time access does not change that distribution. It only gives you more chances to interfere, anticipate, adjust, and act before anything has actually developed. Pay attention to what happens after long periods of watching. Do your standards remain the same at noon as they were at the open? Are you responding to a clear change in market behavior, or has familiarity with every small movement made the market feel more predictable than it really is? A serious trader learns that attention itself must be managed. Not every movement deserves interpretation, and not every hour deserves participation. But once trading fills the entire day, something deeper can begin to happen. Your occupation can slowly become your identity. A losing trade becomes harder to examine when you feel it says something about who you are. That is one of the hidden dangers of making trading your entire professional identity. When there is nothing between you and the result, a mistake can stop feeling like a mistake in execution and start feeling like evidence that you are not the trader you believed yourself to be. Once that happens, objectivity becomes expensive. You may defend a bad decision longer because admitting the error feels personal. You may search for evidence that your original view was right, not because the market supports it, but because changing your mind feels like surrender. The trade is no longer just a position. It has become a test of competence. That is where pride quietly interferes with judgment. Watch the language you use after a loss. Do you say, "That decision was poor"? Or do you think, "I am failing"? Those are not the same statement. One can be studied. The other threatens the self, and threatened people rarely observe cleanly. You need enough distance from the outcome to judge your actions without defending your identity. A trader should be able to be wrong without feeling reduced by being wrong. But even if you can separate your worth from your results, there is still a colder question waiting underneath whether the financial structure supporting your trading can survive reality. A trading account can be profitable and still be too small for the life you expect it to support. That distinction is easy to miss because profitability feels like proof. If the account has been growing, you may assume the next step is simply to live from it. But once withdrawals begin, the account is doing 2 jobs at once, absorbing trading losses and funding personal expenses. Those demands compete. Suppose the strategy goes through a normal losing stretch. The account declines from trading, then declines again, because money still has to be taken out. Even when the method eventually recovers, the capital base may now be smaller, which means the same percentage return produces less money than before. That creates a structural problem, not a psychological one. Look at the account as a business asset. How much capital must remain untouched for the method to operate normally? How much is being removed each month? If ordinary withdrawals require unusually strong returns just to keep the account from shrinking, the problem is already visible. A trader can have skill and still place too much weight on too little capital. The market does not need to destroy the strategy. Steady withdrawals can weaken the structure on their own. And even a well-funded account faces another test that capital cannot solve. What happens when the market stops behaving in the way your method prefers? A method can look almost effortless in one market and strangely ineffective in another. That does not always mean the trader has lost discipline or the strategy is broken. Sometimes the environment has changed. Breakouts stop following through. Trends become shorter. Reversals become sharper. Volatility expands or disappears. The same decision process is now operating inside different conditions. This is where experience can become misleading. If your method performed well during a favorable period, you may begin treating those conditions as normal. Then, when the market changes, you keep applying the same expectations. A setup that once produced clean continuation now produces repeated failure, yet you respond by trying harder instead of asking whether the environment still supports the behavior you are trading. The important skill is not predicting every regime change. It is noticing when the character of results begins to change with the character of price. Are winning trades becoming shorter? Are follow-through moves failing more often? Are the patterns still appearing, but behaving differently after entry? Those observations matter because they tell you whether the market is offering the same game under a different appearance. A professional trader must be willing to reduce confidence when conditions become less familiar, even before he knows exactly what changed. But that raises a harder question. How do you know whether your past success came from a durable process, or simply from trading during the right season? A profitable stretch can answer the wrong question. It can tell you that the trades made money. It cannot by itself tell you why. A favorable sequence can reward weak decisions, just as a sound process can pass through losses. If you build a career decision on recent profit alone, you may be treating an outcome as evidence of durability. That distinction matters because confidence grows faster than proof. A method deserves trust when you can explain what conditions it requires, how consistently you followed it, and whether the results came from repeatable decisions rather than a few unusually large winners. If you cannot separate the process from the fortunate sequence, then the account balance may be giving you more certainty than the evidence supports. Look closely at your own record. Were the trades taken for the same reasons, or did the rules move around? Did profits come from behavior you could reasonably repeat, or from exceptions you would not want to depend on again? Could you identify what would make the method invalid? Or are you calling everything that worked part of the strategy after the fact? The point is not to demand perfect proof. Markets do not offer that. The point is to know what kind of evidence you are actually standing on before you make a decision that is much harder to reverse. And even if the process is sound, one question remains: are you choosing trading because you truly want its daily reality, or because you want to escape the life you have now? Sometimes the strongest argument for full-time trading has very little to do with trading. You may be tired of the commute, the meetings, the manager, the fixed schedule. Then trading begins to look attractive because it appears to remove everything you dislike. That is dangerous reasoning, because escaping one life does not prove that another life fits you. Trading has its own kind of work. There are days built around repetition, record keeping, preparation, waiting, and reviewing decisions that produced nothing exciting. There may be no team, no promotion, no clear finish to the day. If what you really wanted was freedom from structure, you may discover that serious trading requires more structure than the job you left. This is why you should separate two questions that are easy to confuse. Do I want to leave my job? And do I want the actual daily work of trading? They are not the same decision. Imagine the parts of trading that would remain if nobody admired the lifestyle, if there were no dramatic market days, and if the work consisted mostly of preparation, restraint, and routine. Would you still choose it? That answer matters because resentment toward a job can make almost any alternative look better than it is. And even if the daily work genuinely suits you, there is another test waiting: whether the risk you once tolerated still feels the same after the paycheck disappears. A loss does not carry the same weight when your financial life has changed. While you are employed, a losing week may be unpleasant but contained. Your salary still arrives. Your trading capital is not carrying the full burden of your future. Remove that outside stability, and the exact same percentage loss can feel much larger, even though nothing about the trade itself has changed. That is the difference between risk tolerance and risk capacity. You may believe you can comfortably withstand a certain drawdown because you handled it before. But perhaps you handled it under conditions that no longer exist. When another source of income was present, recovery had time. After leaving the job, the consequences of capital loss reach further into your financial life. That changes behavior. Positions you once held calmly may now feel intolerable. Normal fluctuations can provoke early exits. A sequence of losses, that once seemed routine may suddenly feel like evidence that something must be changed immediately. The risk was mathematically familiar, but personally it became heavier. So examine risk under the circumstances you intend to live with, not the circumstances under which you learn to trade. Ask yourself whether the same drawdown would still leave you able to make clear decisions without needing the market to recover quickly. And if you are uncertain about that answer, perhaps quitting should not be treated as a single irreversible leap in the first place. Quitting your job for trading does not have to begin with a dramatic final decision. The mistake is treating uncertainty as something that must be answered with commitment. You either remain employed or resign. You either believe in yourself or you do not. But markets rarely reward that kind of thinking. When information is incomplete, the better decision is often the one that can still be changed. A reversible step gives you evidence without demanding permanent consequences. You might reduce working hours, take a defined period away from work, or test whether your trading routine still holds when you have more time and fewer external constraints. The purpose is not to imitate full-time trading perfectly. It is to expose assumptions before you build your life around them. That changes the quality of the decision. Instead of asking, "Am I ready to quit?" you begin asking more useful questions. What happened when my available trading time increased? Did my routine improve or deteriorate? Did the reality match what I expected? What new problems appeared that were invisible before? Set checkpoints before the experiment begins. Decide what evidence would justify continuing, what would justify returning to the previous arrangement, and what would require further testing. Otherwise, once the transition starts, pride can quietly rewrite the standard. A serious decision does not become stronger merely because it is difficult to reverse. And before you make any version of that decision permanent, you still have to measure what you are actually giving up on the other side. Leaving a job costs more than the paycheck that stops arriving. A salary is easy to measure, so traders often make the comparison there. If trading can replace the monthly income, the decision appears balanced. But employment also builds value quietly, experience accumulates, skills deepen, professional relationships grow, benefits continue, and future opportunities remain open. Those things rarely appear on a trading statement. When you leave, you are not only giving up what the job pays today, you may also be giving up what staying another 3 or 5 years could have created. A promotion not earned, a skill not developed, a network allowed to weaken. Each has a value, even if that value cannot be calculated precisely. That changes the comparison. Do not ask only whether trading income can exceed your current salary. Ask what the path you are leaving might reasonably become. If trading produces modest gains, while your former career could have continued compounding in income, expertise, and opportunity, the true hurdle was higher than it first appeared. This does not mean the job is always the better choice. It means the alternative must be valued honestly. Write down what disappears when you resign, including the things that would be difficult to rebuild later. A decision becomes clearer when both sides are measured by more than immediate cash. And if you do choose the trading desk, the next test begins immediately without a boss, schedule, or outside structure who keeps you disciplined when your own judgment starts slipping. The market does not punish you for breaking your own rules immediately. That is what makes self-discipline difficult. In a job, structure exists outside you. There is a starting time, an ending time, a task that must be finished, and someone who can question poor behavior. At your own trading desk, none of that is guaranteed. You can ignore a daily loss limit, skip your review, extend the session, and return the next morning without explaining yourself to anyone. Freedom removes friction from bad decisions as easily as it removes friction from good ones. One rule broken on Tuesday may seem harmless, but once you prove to yourself that the rule is negotiable, Wednesday becomes easier to excuse. Soon the problem is no longer the original mistake. The problem is that your standards now depend on how you feel in the moment. That is why full-time trading requires rules that still operate when you would prefer to ignore them. Notice what happens after a difficult session. Do you stop when your predetermined limit is reached? Do you document what happened while the details are still uncomfortable? Do you begin the next day under the same standards, or quietly adjust them to erase yesterday? Your real discipline is revealed when nobody is watching. And even after you learn to govern yourself, another test appears when there is nothing to correct, nothing to chase, and almost nothing happening at all. Boredom can become a trading signal if you are not careful. A quiet market does not always create risk through bad analysis. Sometimes the danger is simpler. You want something to happen. After enough stillness, a weak setup can begin to feel interesting simply because it breaks the silence. That is how stimulation disguises itself as opportunity. The trader who needs action starts lowering the threshold without admitting it. A move that would normally be ignored gets a second look. A marginal pattern receives more attention than it deserves. The trade is not being selected because the market became clearer. It is being selected because doing nothing has become uncomfortable. That distinction matters. If activity gives you relief, then the position is already serving an emotional purpose before it serves a trading purpose. Once that happens, your judgment is no longer measuring the setup alone. Watch your behavior during uneventful sessions. Do you begin searching new markets just to find movement? Do you reopen charts you already rejected? Do you feel strangely satisfied the moment you finally enter something, even before the trade proves anything? Those reactions tell you whether you are waiting for opportunity or waiting for stimulation. A professional trader must be able to finish a day with nothing to show for it except restraint. But once you learn to tolerate inactivity, another danger appears, filling that empty space with more opinions, more news, and more information than your process can use. A trade can begin with one clear reason and end under the influence of 5 different opinions. That usually happens after the position is already open. You read a headline, hear a market commentator, check another trader's view, notice an economic forecast, and suddenly the original thesis is sharing space with information that was never part of the decision. The danger is not that the new information is always wrong. The danger is that it may be irrelevant to the method you are using. Once unrelated inputs enter the trade, management becomes inconsistent. You hold because one source sounds bullish. You tighten the stop because another expects volatility. You exit because a headline creates doubt. The position is now being managed by a collection of narratives instead of a defined process. That weakens judgment because every piece of information can justify a different action. Before you take a trade, know what information has the right to change your mind. If a news item, data release, or market relationship was not part of the original logic, ask whether it truly alters the setup or merely alters your confidence. More information does not always create more clarity. Sometimes it only creates more reasons to interfere, and when you spend enough time alone with that stream of information, another problem begins to form. There may be nobody left to tell you when your thinking itself has started to drift. Trading alone can make bad thinking feel more reasonable than it is. When you work around other people, your behavior is constantly being reflected back to you. Someone notices when you are unusually tense, distracted, overconfident, or fixated on one problem. At a private trading desk, those small corrections disappear. You can spend days inside the same interpretation without anyone disturbing it. That matters because the mind is very good at defending its own conclusions. After a difficult trade, you may replay the same reasoning until it sounds stronger. After a good run, confidence may rise gradually enough that you stop noticing the change. Without outside reference points, a temporary emotional state can begin to feel like clear judgment. The solution is not to collect market opinions. Other people do not need to tell you what to trade. What matters is having some form of external reality check on your behavior. Notice changes that would be obvious if someone else were watching you. Are you sleeping differently? Talking about one trade repeatedly? Becoming unusually certain? Avoiding people after losses? These are not market signals, but they can reveal when your internal calibration is drifting. Isolation becomes dangerous when there is no difference between the voice making the argument and the voice approving it. And once other people do enter the picture, a different pressure can appear. especially after you have publicly told them that trading is now your profession. The decision to become a full-time trader changes the moment you announce it to everyone around you. Before that announcement, changing course is private. After it, reversing course can feel like admitting failure. Friends ask how trading is going. Former colleagues remember why you left. Family members may quietly measure whether the decision worked. Now you are not only evaluating results, you are defending a public choice. That pressure can keep a bad decision alive. When performance deteriorates, you may extend the experiment because returning to work feels embarrassing. You may explain away evidence you would normally respect. Another month becomes reasonable, then another, because stopping now seems to confirm every doubt other people had. The danger is not their judgment. It is allowing imagined judgment to change your own standard of evidence. Before making the transition public, decide what would make you reconsider it. Write those conditions while your reputation is not involved. If they appear later, judge them against the standard you set before pride had anything to protect. Ask yourself a difficult question. If nobody knew you had quit your job, would you make the same decision today? Your ability to reverse course is valuable. Do not spend it merely to preserve an image. And even when outside opinion no longer controls the decision, success can create another trap, because profitable months have a way of quietly changing the life those profits are expected to support. A strong run in trading can increase your financial pressure long before the market turns against you. The danger begins when temporary profits create permanent expenses. A few good months make a larger apartment feel reasonable, a new car seem affordable, or higher monthly spending feel normal. The income was variable, but the obligations become fixed. That difference matters. Profits come in unevenly because markets do not distribute opportunity on a schedule. Expenses do the opposite. They repeat. Once your lifestyle expands, every future month is measured against a higher requirement, even when market conditions are ordinary. Then a perfectly normal slowdown can feel like a crisis. The problem is not that you made less money. The problem is that yesterday's success changed what today must now provide. Trading stops financing a flexible life and begins carrying commitments that cannot easily shrink with the account. Watch what happens after unusually profitable periods. Which expenses quietly become normal? Which purchases create recurring obligations? Are you treating a temporary increase in income as evidence that the new level will continue? A trader should be careful about turning a good season into a permanent standard of living. The more rigid the lifestyle becomes, the less room there is for trading income to remain irregular. And there is another distortion that can grow during profitable periods. Judging the quality of your decisions by how much money they happen to make. A profitable trade can teach you the wrong lesson if you judge it only by the money it made. Suppose you ignored your entry rule, chased the move, and still finished with a gain. The account rewards you, so the mistake feels harmless. Do that often enough, and luck begins training your behavior. What was once an exception slowly becomes acceptable because the outcome kept forgiving the process. Losses can mislead you in the opposite direction. You can follow your plan exactly, take the setup you were supposed to take, manage it correctly, and still lose. If you treat that loss as proof of a bad decision, you may start changing sound behavior simply because randomness produced an unfavorable result. That is why professional judgment must separate execution from outcome. After the trade, ask two different questions. First, did the decision follow the rules and information available at the time? Second, what happened financially? Never let the second answer erase the first. A bad trade that wins deserves correction. A good trade that loses may deserve repetition. Without that distinction, your trading process gets shaped by whatever happened most recently instead of by what was actually done well. And once you learn to judge decisions properly, another temptation appears, assuming that being full-time means you should expand into more markets, more setups, and more ways to trade. Going full-time can make a narrow edge feel embarrassingly small. When trading becomes your occupation, you may feel that one market, one setup, or one session is not enough. There are more hours to fill, so you begin adding instruments, time frames, and patterns that were never part of what made you effective. That expansion can look like progress while quietly reducing competence. Every market has its own behavior. Every setup has conditions that make it useful and conditions that make it unreliable. When you spread your attention across unfamiliar territory, you increase the number of decisions you must make before you increase the quality of those decisions. The danger is not simply trading more. It is losing track of where your actual advantage ends. Ask yourself why a new market or setup is being added. Is there evidence that your skill transfers there, or does the expansion merely make the trading business feel more complete? A professional does not need to participate everywhere. He needs to know where his judgment is strongest and where it becomes ordinary. Depth often looks unimpressive from the outside. The same setup, studied repeatedly, may produce fewer stories but clearer decisions.